Well, good morning, everyone. It is promptly 11 o'clock, and we are here to start our fourth quarterly market outlook. And for those of you that are new to the quarterly market outlook, I'll go through the rules of the road one more time for now. And a few things. One, throughout the quarter, every day, all day, we're constantly inundated with charts, graphs, information about where the economy is going, where the market's going, and we are sifting through that data to use the most unbiased, conflict-free information to build a story that's going to help us indicate where we're going with the market, where we're going with our portfolios. And what I do is I try to collect the best of that information and consolidate it in an hour-long presentation that I'm here to present to you all right now. So also, please note that Brett is behind his computer, and he will be taking in all the questions that you guys pose. So there should be on the bottom of your screen a little Q&A button. So you can find that, type in your question, and Brett will get the question over to me. Some of them I'll try to answer as I'm naturally going through things. And I'm certainly happy to go through. If there are things that I don't get to in the market outlook, I'll happily write you an email. And if you want the slide deck, certainly let me know and we'll be happy to send it your way. So with that, we, again, as always, have a ton of slides, a ton of data, and a ton of information. So I'm going to go ahead and share my screen as I'll periodically shift it to keep things interesting back and forth with where we are with the market and the economy. Let's go ahead and dive into the market outlook. So the first things first, there's going to be a lot of talk about inflation throughout the whole course of this economic market outlook. I think that this quote, to me, feels critically important that we make sure it's clear. So when inflation is low, Peter Bernstein said, you feel that you know more about the future and are much more willing to take risks. So we have been coming out of a multi-decade low period of very moderated inflation. And we have entered a new period right now. We don't know how long it's going to last, of extraordinarily high inflation. And as a result of our inflation environment, we do need to take a pause. We do need to reassess risk positions. As you'll see, we have a lot of data that indicates and proves unequivocally that when you have high inflation environments, it does mess up the valuations and change the valuations of an inordinate amount of investments. And inflation is going to wag the tail of the economy. And so something we're going to pay a lot of attention to throughout the course of this market outlook. And this is, of course, the Fed chairman. You guys should all know and recognize him by now. Really, and that's been the theme of our market outlook. It's kind of that whack-a-mole game that as soon as something pops up, the Fed has been trying to continually knock different aspects back down that have cropped up, that have created some economic problems. Like we had some bond market issues, which we'll talk more about, in bond market performance, with bonds having one of the worst years in recent memory and investment memory for many people who have been at the job as long as I have. The job market, we're watching the job market closely. Can the job picture stay where it's at? The housing market, we're seeing some changes there with housing prices. And as the Fed is battling all of these different components, in remembering the fact that their mandate is based on three principles, it's maintaining that price stability or inflation, it is the stable job market, and three is kind of that economic growth as their third pillar. As the Fed's working on each of those three mandates simultaneously, there's a lot that they have to kind of organize and put together in order to make sure that they're using their couple of tools to maintain all of those three things at once. And it must feel like whack-a-mole to them. Because no sooner does this one seem to get fixed than something else crops up. And it can be seen very clearly in the third quarter. And this is the performance through September. The next chart will show you the performance year to date through Monday. But if you look there, this tells you a story in terms of a 60-40 stock to bond portfolio, negative 21% year to date. Small cap stocks down 25. You see that in these quarterly numbers for -5, -2, -9. It was a very difficult third quarter. where you saw a continuation of some real negative trends. Even here, the yellow are your bond positions. You're seeing, again, with interest rates rising, that we're seeing some real negative bond performance, which has continued. REITs and real estate positions, we're not immune to this as well. The two areas that held up year to date through September, that midstream energy and commodities, really, that's how we position client portfolios. You may see things like the MLPX fund, which is think of it as a balanced investment that is in the energy distribution sector. And if you look year to date through Monday, this chart is a little bit broader than the one before, but it shows you the same consistent trend. Yes, we have had slightly better performance starting in the month of October, still largely negative across the board. Again, you throw in things like cryptocurrency, it's had a disastrous year. But again, your midstream energy position, the one that's holding up the best, or your commodity-based futures. So as we look at the performance of the market on a sector by sector basis, this is where you start to say, well, I hear you that the market's down, but is it every area of the market? And the answer is no. There were a couple of areas that perform well: energy and the defensives part. You can see these are the two areas of green year to date. And then everything else virtually is red across the board in terms of its negative performance year to date and over a 1-year basis. What I want to draw your attention to is that, I just want to make sure that we're all acutely aware that the investment principle of buying low and selling high, certainly not attempting to ride things that are going well. So, for example, when you see that energy is up 61% year to date, it might be natural to assume that this has probably just been the best place to invest all along, and that's definitely not the case. So I've highlighted here, look at the performance in 2020, -32. Look at the performance in 2018, which was -18. In 2017, had a negative performance right there. So if you were looking at energy as a sector through those markets, you say, geez, that's something I might want to stay away from. COVID certainly put a nail in the coffin for energy, but before people were ready to bury energy investments across the board, no sooner did that happen than I think that the stock market remembered that, despite the fact that we're making all efforts that to become the kind of country that's going to rely on other green sources of energy, we're not there yet. We still do need and use natural gas. We still need and use oil products of all kinds and varieties, both in machining and automotive and distribution and transportation, these industries aren't dead. So we've seen great performance there. We've participated in it as much as we can as part of a balanced portfolio. You never want to take any short-term performance and then say, well, I'm going to go ahead and base my investment thesis on that. So given the fact that we had good years in a couple parts of the market, difficult years in others year to date, where does that leave us for our forecast for 2023? So I'll share some key themes that I've identified for you. So I'll go through and I'll try to highlight them as quickly as I can because I have more slides than time. We have structurally low growth forecast for 2023. So the big part of the problem that we're seeing, and for those of you that watch and stay in touch with the news, you'll likely see that the issues that are going on in Europe with their current and likely future going into the winter energy crisis, even though natural gas reserves are at 100% capacity across many parts of Europe, I get that. There's still real structural issues with demographic issues, which are going to lead to some difficult inflation components for them. That is both in Europe and Japan. And as those economies may struggle more than we do here in the United States, we're not immune if they have a problem that is going to cause some kind of economic turmoil for us here in the United States. So we're forecasting, again, some additional challenges in 2023 there. Consumers can only spend so much. We're going to spend, I've got charts and graphs on consumer spending, of course, as always. I always check on consumers because as the consumer goes, so goes the US economy. And what I can tell you is that the consumer is getting to the point of some levels of exhaustion. So we're looking at again, potentially a slowing economy. We know that the COVID stimulus money is being worked through. We're seeing what's happening with credit card balances. So we're seeing some challenges with potential for consumer spending going into 2023. So our policy looks like from the Fed will be mostly restrictive. Again, and the Fed's doing this in two ways. The Fed is raising interest rates and they're also shrinking their balance sheet. As they shrink their balance sheet, they're literally like a giant sponge absorbing a lot of excess liquidity that was placed into the worldwide markets. They literally flushed trillions of dollars into our economic system, and they're slowly start to pull some of those dollars back as we may be heading into a recession while raising interest rates. So though the Fed's going to be restrictive, and that's going to create some level of challenge because our baseline analysis is that the Fed's going to end up increasing interest rates and doing this restrictive policy till something breaks. We'll talk more about that as we go along. So be patient and cautious. So we are waiting for that Fed pivot, because in as much as we may forecast for some future dislocation, economically speaking, in 2023, what you don't do is you don't invest and then wait for the economy to rebound and then start investing. The stock market will rebound way before. So if you look right now, the stock market of today is certainly pricing in a recession in the future. That's already happening. And if we are looking actively for that market bottom, and that may come when the thought process is, hey, maybe the Fed's going to pivot. Maybe the Fed is done increasing interest rates and being restrictive with their economic policy. And if that's the case, we would be more constructive. When we do invest, we're going to be looking for high quality businesses with great cash flow that also have been unfairly punished. So we've created a growth portfolio. Some of you will be seeing it. For those of you that are looking for growth, it's a concentrated, we'll keep it somewhere between 12 to 15 positions, where we are dedicated towards identifying areas of real explosive growth and opportunity. So look for more of that to come. We're going to maintain a U.S. emphasis for reasons mentioned above. And we see that there's a potential, a potential hedge, with this midstream energy as we've been participating, gold miners as we've been participating in. We think that there's some good tailwinds to potentially help us next year in real estate. So many of you have seen that we're expanding our real estate holdings as we're considering making additional investments in that market right now, because we know that there's a lot of dislocation. So the great moderation, really, as we look back, is a pocket of time where we can see here, I circled it in blue, where inflation measured here in yellow was moderated, was low. We got used to this kind of 2% inflation number, where decades before, it was more like a 3 to 5 was that pocket of time where we were used to the cost of living and the cost of our goods and services going up by 3 to 5. We got used to this 2 number. For those of you that were in the 70s and 80s buying homes, I just met with a family yesterday that bought their first home in 1979 and did so with a 15% mortgage, and they had to buy points in order to buy their rate down. There's been a lot of different cycles. We are entering a new phase, and you can see here inflation measured in yellow that has raised the cost of living quickly. And there's a lot that we need to deal with, because there's going to be fallout as assets need to be repriced. It's just the biggest question that you should have, and that I have, and that we all have as we meet 2 times a week as a part of our investment committee at InterOcean, is will that inflation be sustained? Will that be the new normal, or where will it come in the year or years ahead? I do have what we think is our likely forecast on that. I'll be getting to it. And again, this is the challenge, and we've had this historically low inflation, and what what you see is that when you get inflation, by the way, this chart is inverts the numbers a bit just to show you that there's a direct correlation to valuations on the publicly traded market, like stocks, things like that. The valuations come down as inflation goes up. And this is a relationship that exists even to and through today. So when I keep talking about inflation and the importance of it, it's going to have a impact on stock prices, and we have seen it. We'll continue to see it, so we're watching it very carefully. We're again, the risk of recession for next year is high. Again, I've mentioned that the market believes that we're in it. The bond market is also pricing it in with that inverted yield curve, where you've got short yields higher than your longer term bond yields. So you've got the stock and bond market that are both thinking a recession of some kind of variety. I will tell you that the stock market doesn't think it's going to be a draconian and awful, a disastrous recession, but something that is going to be different than what we've experienced. This is kind of your economic growth, your GDP growth that we were experiencing 2018, 2019. You've got COVID, you've got your rebound from COVID. This is not much economic growth. And it's important to know what the economic growth projections are, because again, we're talking about companies growing their earnings. And if the economy is not growing, then it just makes it a little bit harder, more difficult for companies across the country and across the world to grow their earnings. So this is a challenging environment that companies will be getting into. Some will fare better than others. We're going to try to identify those companies and avoid the ones that don't. But and this is just showing you that the probability of a recession starting to increase with the Atlanta Nowcast. I'll just quickly go through this. I mean, PMI, which is your manufacturing index, you're seeing that from a manufacturing standpoint, the rate of expansion here in blue is coming down toward that 50 line. Anything under 50 means we're no longer expanding. So we are expanding, but you can see the trend is moving pretty decisively downward. And if you look at like the services PMI, also the same trend. So both on manufacturing and on services, you're seeing the trends come down, which is just showing you that economically speaking, both on the manufacturing and even the services side, yes, we're still expanding, but the rate of expansion is slowing. So you look at that trend and it's a cause for concern, which is why the market does what it does. At least it's part of the reason why. But at the same time, when we're talking about inflation, again, and I've got a bunch of slides on it. This is just one. What it clearly shows is that the rate of inflation across the world has started to moderate. This is your inflation surprise index, which is just one way that we measure the trend of where inflation's going. So we don't feel like it's accelerating. That doesn't necessarily mean that inflation's going away. It doesn't mean that, oh, okay, good. Now that this is turned, we're all good to go. That's not it. That's not the case. But we are seeing some improvement there, and it's just whether or not because this thing needs to continue to go down to such a level where we see inflation getting back to more normalized levels. Because right now, if you're looking at our baseline inflation rate, look at core inflation north of 6%, that's high, and that creates a difficult economic environment. We're seeing some improvement. That's good, and the market's certainly reacting to it. And when we're looking at what the Fed is going to do to fight inflation, here's part of the problem. This chart I love because it goes back to the 50s. And for those of you that watch, our quarterly outlooks that we do, and we've done them for years and years and years, you know that I love long dated charts. Who doesn't? Because you get a better sense for what history looks like, and and we do think that even though history doesn't always repeat itself, we think it rhymes. And here, what you'll see is that you have this inflation adjusted Fed funds rate. And what you can see is that, never before have we had an inflation adjusted Fed fund rate be so out of whack, where this dotted line shows kind of what the Fed has done to combat that. Normally, you've got a nice big kind of like wide gap here, and we haven't seen it. Yes, the Fed's starting to make a move, but it's woefully behind schedule. And if you look back to history, you just don't see where the Fed has reacted this slowly. I mean, if you look back, inflation was riding at, 8, 7, 8, 9%, even going back as far as March. And at that point, we had zero interest rates and they weren't shrinking the balance sheet this year. So the Fed was slow to act. And it is something that the Fed is catching up for. We're aware of it. The question is how far will they go? One of the things that the Fed looks at is they look at commodity prices. And we've seen commodity prices roll over. This is part of the reason why we think that in 2023, we think that there will be a pretty nice rebound. That's part of our gold miners position that we have for many of you. We're going to talk a little bit more about the home price index. I've got some home data. So there's two things that I wanted to point out. One, we're aware that the home price index has changed. We're aware that home prices on a year-over-year basis are still elevated if you look back in terms of how far home prices have gone up. But at the same time, we know on a month-to-month basis, we're seeing home prices start to slip. We know why that is, which we'll get to. But this is so if you want to know why home prices can be going down and commodity prices could be going down, and yet the inflation numbers aren't going down necessarily lock in step with it. I could do a whole hour on the way they calculate inflation, but here's what I'll tell you. Inflation is, they smooth out the number. It's done on a careful basis. It's done on a graduated basis. And as a result, they are taking these home price numbers and they slowly kind of average them in. So it will be another number of months. It will be at least another 6 months where the home prices that we have seen are slowly finding their way into our CPI or our inflation calculation. And that's going to keep the inflation number that you see on the news, whether it be the business news or whatever news media outlet you turn to. You're going to see this kind of persistently high number because we're slowly filtering in these older housing numbers. It's just the way that they smooth out the data. So our inflation peaked, let's call it right around 9%. If we did not use that smoothing method, if the government didn't use that smoothing method to calculate inflation, I have read that it depends how you do it, but it's either 14.5 to 16% would have been the peak inflation number here in the United States. Now that would have been shocking. That would bring, all the look and the feel of the difficulties in the late 70s, early 80s, that inflation environment and all kinds of chaos. So we peaked at 9.1 because we smoothed out the numbers, and we're expect to see it though persistently higher for longer, which is arguably gonna give the Fed ammunition to keep their foot on the brakes and slow the economy down, even though they know that the information that goes in there lags. It's interesting. So here's what we think, as promised. So this is what we think that inflation will look like going forward. This was at peak 9.1. You've seen inflation numbers start to improve, which is great. But here's what I want to remind you, is that even though inflation peaked and started to come down, what has the Fed done? They haven't changed anything about their tone, their message, or interest rate increases. And in fact, next week we expect, even though we've seen the curve come down some, we do expect that next week the Fed's going to be increasing another 75 basis points. The question is that will there be anything in the language that gives us an indication that for some reason they may be pausing those increases? It would be surprising because the inflation story hasn't ended. And if you can see month over month over month, where as the new real estate numbers filter in, as the new home rental numbers, or I'm sorry, just any kind of rental numbers for real estate, as those come in, as commodity prices continue to filter in, as the smoothing method takes in the lower data, it's going to take a number of months for us to get back down to normal. So many believe that the Fed will be comfortable once inflation hits 5%, because that will be enough of a path that hopefully will allow them to relax into making an announcement, generally speaking, that we're going to take our foot off the brakes and we're not going to be continuing with our interest rate increases. But that may mean that there's increases between now all the way through the first quarter of 2023. That could be difficult for the market environment. And the Fed target, if all things being equal, if this chart does come to fruition and it's just perfect, that would mean that we would have a normalized rate of inflation by June of next year. Don't know if that's going to happen. We'll have to see if the economic data comes in, but there's a lot to be concerned about and a lot to watch for, because numbers change. We want to look at the numbers that we're facing right now in the stock market or the bond market and say, well, the numbers as they reflect today show us exactly where the market's going to be next week. And we know that they don't. And if you look at this, look at the dotted yellow line versus the solid. The dotted yellow line shows what interest rates were like before we got the CPI report or the inflation report in September. And then 4 days later, what happened after we got the inflation report. Same thing in October, before the inflation report and after the inflation report. What I'm telling you is that the market continually is adjusting interest rates and market prices as new data comes in. We'll have to wait and see, because if this ends up happening, I could tell you the market will likely sometime in and around this time period, start to move higher aggressively, forecasting that this is going to be the case. And you'll see, because these adjustments happen in real time. We're seeing that the Fed is increased interest rates here this is the yellow, and you can take this back to 1992. You had this really nice sequential line, and I pointed to it every single quarter that we had this long-term trend that hadn't yet been broken, where the Fed had not increased interest rates to a degree that was changing this multi-decade, it technically goes back 40-year slide to interest rates. That trend has definitively been broken and is indicative of the fact that the market believes that the Fed will increase interest rates somewhere up to 4.25, 4.5. We'll have to see if that indeed ends up happening, but this is what the bond market is telling us. If that does happen, then look out interest rates with regards to home mortgages and a whole bunch of other things, which I'll try to get to and cover. Because again, right now, if you look at where these are the assumptions that the market had going into the past couple of interest rate cycles, again, we're expecting here in November that 75 basis point increase. We're expecting then in December another 50 basis points. We're expecting in and then by June to end up another 50 basis points higher. The market hasn't decided if it comes in 25s, but this is essentially how the market has forecasted the Fed's future actions. And this is also part of the challenge, is that you can see that things have changed over time. New colors have been added. If you look back to where we were even a couple of quarters ago, I've had these charts and we weren't expecting this many interest rate increases. The Fed has done them because they're reacting to persistently high inflation. I do think that inflation is going to be a little bit higher than the market's expecting for a little bit longer than the market's expecting, which is why we're forecasting some continued softness along with the troubles that, as I mentioned, in Europe. So we'll have to see how that all comes together. As promised, I've got your residential real estate update. I didn't put a ton of slides in it. I just wanted to summarize it in one for housing prices, because it just seems that, what galvanizes a lot of our clients is their desire to know what's happening with the regular residential home market. So as homeowners, and many of you on the call are, you want to know why home prices have gone down. Here's your answer. Here's your 30-year fixed mortgage rate, which hit over 7. And it hit over 7 for the first time in many decades. And it moved because there's this gap. There's a lot of reasons why that it moved, but one of the things that mortgages price themselves off of is the 10-year treasury. And you can see there's this gap in between the 10-year treasury and that 30-year fixed mortgage rate, pretty consistent. And as we've seen that 10-year treasury rise, we've seen this pretty precipitous rise in the 30-year mortgage. Questions abound. Will we hit 8%? Will we hit 9%? I'm sure that if you Googled, will we hit 9% mortgages, you'll find an article of someone who thinks that, or 10%, plug in whatever interest rate you want. It seems increasingly unlikely that we hit this 8% number. That would mean that there is a real serious dislocation, economically speaking, in the 10-year treasury. Just absolutely surges from where we are right here. There doesn't seem to be much in the way that that's going to happen. So I would think that from a 30-year mortgage challenge that the housing market's facing right now, which has moved up housing prices, that may be part of the challenge that's been solved. And if you look at home inventories, I mean, look at this trend from 2005 to today. Yeah, there's been some waviness, but there's just is not a lot of homes for sale on the market. And you couple that with now less homes being built. Okay, so what you've got is you got a couple things smashing together. You've got these 30-year mortgage rates at 7, and you've got a small supply, which speaks to why the housing price decrease that we've seen isn't significantly worse. We're not seeing anything really in the way of mortgage defaults. We're not seeing anything in the way of banks trying to get rid of properties. So the result is not a lot of inventory, not a lot of new homes being built, and this is a natural fixer for maintaining home prices. So that's the good news in terms of home prices. If we see supply start to come on the market, or if you see housing start to rise, which is another leg of supply come into the market, then that may end up hurting home prices. But if you see the 30-year mortgage come down, that might help it too. We'll have to wait and see how that comes through. And when we're looking at the strength of the consumer, there's a few different slides that I wanted to pull in with the latest data. And one is this kind of average hourly earnings growth. So look at this long-term trend. I mean, really, the average hourly earnings growth for the bulk of the mid 2000s was pretty stagnant. So slight increases to average hourly earnings, which was largely okay, meaning because inflation here in blue was less, the cost of living was going up less than people's wages. If people's wages are going up more than inflation, then their dollar goes further. That's a good thing, particularly here where you've got no inflation, wages are going up, people's quality of life starts to get incrementally better. Again, a nice pocket here, incrementally better. Transfer payments from the government with COVID, a lot better in terms of people's finances, disposable income. And then you look, and here's the issue, is that, yes, wages here in gold have gone up more. And look at this kind of trend. If you look, obviously you got this COVID pocket, but you've got wages that have gone up more than they have in a really long time on a pretty consistent basis. But now with inflation doing what it's doing, folks are noticing month after month that their dollars aren't going as far. As a result of their dollars not going as far, look for that to change consumer behavior. This is part of what I talked about earlier with the 2023 forecast. And, it's important to look at these things because you got to look at things both ways. I would say that it depends upon which news station you watch and what the political agenda is, but you'll see both of these numbers and they're both right. Average hourly earnings inclusive of inflation over the past couple of years is flat. Average hourly earnings on a real basis is, wow, people should feel really wealthy, but on an inflation adjusted basis, it really hasn't changed much. So this is the real data. This is the no spin political agenda, no political agenda less answer to the question. And that is consumers just don't feel a heck of a lot better. And particularly lately, they're going to start to feel worse. Again, real personal income, it's been on this trend other than COVID. We're back on trend with personal income. in disposable income, because borrowing costs are going up, has fallen off of trend. Yes, we built up a bunch of extra disposable income here. We're under here, but we're watching this because, again, as the consumers feel the pinch, they'll spend less. Again, I mentioned this before, but debt payments as a percentage of people's household income, we saw during, particularly during COVID, we saw people pay down their debts aggressively. We're seeing that reverse. And we're seeing the amount of credit card debt here measured as revolving debt fully rebounding to where we were with COVID. So as I mentioned in that slide previous for 2023 forecast, there's the consumer is showing signs of strain. We're seeing it with the personal savings rate. People were saving their COVID checks, their transfer payments, call them what you will, from the government. We're right back down to this kind of baseline level with where we had been in terms of people saving kind of that base minimum amount. And we're looking at that revolving credit change, which is the most dramatic increase to to credit card debt and balances in a short period of time than we've seen in decades. So I don't know exactly the extent to which consumers will start to change their behavior, but I'd expect we'll see some of it in 2023. Certainly on the lower end side, there's always that difference where there's the high end consumer is better able to withstand price increases. So we just adjust our portfolios accordingly because not all companies are focused on the same kind of consumer. So there's a lot there. There's a lot in this chart. What I wanted to show here is that bank balance sheets, the rate of change in bank balance sheets across the world, not just our own central bank, but central banks across the world, we're seeing those things now finally start to shrink across the world. So what we did here in the United States with our central bank when we injected about, let's just call it $6 trillion from the Treasury to the Fed into the economy, we're starting to pull that back. We're not alone. Japan and the European Central Bank doing much the same thing with their balance sheets. The projection is to see a slight decrease, and Bank of Japan will have to see, because they're going through a whole bunch of their own issues, what they end up doing throughout the course of the year. When we look at different areas of the economy, let's look at whether people are traveling. And if you've been to the airport, it's full. Here's your proof. The TSA traveler data is about where we were in 2019. Yeah, we did peak out here in 2019. Looks like June, summer. We'll have to see where we are this year, but there's been a really nice rebound in travel. Where there hasn't been a nice rebound is in office. My goodness, we're all back in the office. But if you look at the 10 major metropolitan areas, from DC to New York, look at the chart, it is less than 50% of those folks in those major markets, less than 50% of them have gone back to the office to work. So, man, there's just a big part of the economy that just hasn't fully normalized itself. And we're seeing that, you look at the hours that restaurants are open and things like that, you're just seeing a pretty significant change, and it doesn't look like it's going to be getting back to normal anytime soon. I decided this year that I wasn't going to do a big piece on the upcoming midterm election. In prior market outlooks, I certainly have, but what I will say is this. Right now, it is in some states here, like in Arizona, there are others across the country in gray, where it is a bit of a toss-up in terms of what's going to happen in the election race. Like when the election races, is it going to be Democrat, Republican? We're just not sure. We don't know. We don't know where this is going to filter out. But here's what we do believe. We do believe that irrespective of a Republican or Democrat majority, House and Senate, and some, like in the House, appear more inevitable than maybe in the Senate. But no matter where Congress goes, we still have, the Biden administration where it's at, and there's likely to be some level of gridlock. There likely will not be an overwhelming majority either side. And without an overwhelming majority either side, it tends to mean, historically speaking, that less is done. And when less is done, that's a factor. I mean, so it's a factor because it usually means that there's nothing dramatic going on. And if there's nothing dramatic going on, that's one less element we may need to have to be concerned about. No major bills or packages or things like that that could create some confusion. So whoever wins from a financial standpoint, it's like, we're going to be okay either way. With respect to the Russian-Ukraine conflict, what I would say here is that we've seen a real big decline back down in European natural gas. I mentioned they built supplies. We'll have to wait and see that situation evolving. And then, putting kind of this, Fed pivot situation. And I mean by pivot, I mean when the Fed starts to be less restrictive and with their policies. I go back into history to look to see, all right, let me look at all the kind of the prior Fed pivots from 1957 to 2022, and when in these past 16 cycles, like, how high was the Fed funds rate on average, and what was unemployment looking like, and what was inflation looking like, and core inflation, and real GDP growth. And so the historical averages don't help us much. Because we've got a lot of very abnormally high data here. We have some historically low data here in 2018. But what I would say is when I look at this information, I'm saying that within core inflation at 6.3, it's stubbornly too high for the Fed to just abruptly stop, and headline inflation at 8.3, just for the Fed to just, things are going to be fine. In real GDP growth, at 1.8, which is saying that, and we've got a pretty good GDP print since this information was gathered, by the way. So we had a pretty good GDP print for Q3. So as we look at all this data, it gives the Fed continued motivation to keep their hand on that brake, slow the economy down. And, I don't see anything in here that's suggestive of the fact that this Fed pivot's coming within the next number of months, maybe sometime in that first quarter of 2023. Okay, so with stocks are dropping back into bear market territory again year to date, it was just a difficult environment for emerging markets, large, small, you name it. We have seen some valuation improvement, and by valuation, what I'm trying to say there is the stock market is made up of a collection of beliefs, and those beliefs are how much am I willing to pay for every dollar earned for a particular company? And some companies, I like them so much that I'm willing to pay $20 or $30 for every $1 they earn. And the stock price adjusts, at least in part, based on how much they're worth as a multiple of what they're earning now and in the future. So we've seen in PE ratio is that, as I described that multiple, we've seen this multiple come down kind of from the red line where it's overvalued. Here, this is the dot-com bubble. This is that kind of peak valuations that we got during COVID. The yellow line is like more of a median. We're back to kind of that baseline. And anything in green, should you be fortunate enough to be able to accumulate stocks when valuations are this low, these are the ideal times where you want to just be buying stocks with both hands. But this is favorable, so we're getting favorable. So you'll notice that we haven't, walked away from our market positions, and we're slowly starting to add. The question becomes, as we're looking at earnings, will we see a meaningful decrease or drop or cut to earnings? We've lived through this third quarter earnings estimate. We're looking back through the earnings that were for publicly traded companies ending in September 30th. And largely those numbers have been pretty good. So we haven't seen corporate earnings take a major hit yet. Until this week, we started to see things that are coming through from the big mega cap tech companies. Google and Amazon. Apple's earnings were pretty good. Facebook and many others just got absolutely crushed with their earnings. So we're waiting to see, will we end up having these major earnings down drags, which you end up getting in recessions. So if we're forecasting a recession, part of an element that you'll need in order to complete that recession is kind of that pull down to corporate earnings We haven't seen it yet. And if we do end up seeing it, that's likely that next leg of the market move lower. And that's likely when we start to get much more aggressive buying stocks. Enterprise value, again, we're seeing, we have seen an improvement in, again, the valuation on companies. This is another way to look at it, price of sales. We've seen an improvement there as well. All of that is great. We haven't, this is in yellow are these kind of recession environments. We haven't seen, we see again a slight earnings growth here, but I wonder if over the next couple of quarters, if we're going to see the earnings, the real earnings number start to decline. Haven't seen it yet, the real earnings, but we'll have to wait. It would seem likely to me, if we do indeed hit a recession, that we will end up seeing an adjustment to those earnings numbers. And we're seeing improvement, which is great. We're seeing improvement. Wonderful. I guess I thought it was a good idea to just keep putting all the earnings slides in here. If you look at the pure growth, growth has had much more of a drawdown compared to kind of value. And by growth, I do mean the tech companies, those high flyers. We've seen the valuations come down still more than the value companies, your dividend payers, even though the value-based companies, that we've seen a valuation pull back there as well. So let's wait to see how this shapes up for small size companies. Each one of these points on the bottom are ideal opportunities to buy. We've got one that's pretty decent now. So we're not afraid of stocks, certainly on the small side, but it's not a screaming buy signal. I mentioned several times throughout this market outlook that as inflation's high, it can create valuation problems for stocks. Here's your data set. When you get inflation that's persistently high, like over 6%, you can see here in red, we did all this talking about earnings estimates or earnings multiples. Multiples are the lowest when inflation is high. And this goes back, 75, about 100 years worth of data. So high inflation, low multiple, we know that. We have high inflation, multiples are coming down. The problem is that we know that when inflation's high and rising, that stock market is gonna likely be negative. But we also know that when inflation really starts to fall meaningfully, inflation's high and starts to fall, we see that there's pretty positive potential for stocks. So this is starting to set itself up for what we believe is going to be another ideal opportunity for us to invest. The last time we did something like this was April 1st of 2020. It didn't feel good to invest at that time, but we certainly went ahead and did. It worked out wonderfully. We did the same kind of thing December of 2018 at the end, December 24th, if memory serves correctly. And we're looking for those opportunities where we can increase risk, certainly in areas of the market that offer us the most upside. Stocks are, believe it or not, they may be cheap, but bonds are even cheaper. This is another way of looking at whether or not we're getting extreme buy signals. We don't see extreme buy signals. I've gone through this chart in past market outlooks, so I'll skim through it, but it shows you that every time the Fed throughout its history has increased interest rates quickly, the market has a negative performance. Sometimes, but when the Fed increases interest rates and they do so slowly, the market tends to perform very well. So we knew when the Fed was going to increase interest rates quickly, we knew that there was likely to be market negative performance, but we'll have to wait and see exactly when the Fed stops. We've talked about that quite a bit. I did want to spend a second on private equity. I have had a couple of clients that said, geez, I have these other investments that seem to be doing really well. And what are they? Oh, they're investments in like these venture capital, private equity, other businesses. These are things that are not in the stock market. And say, well, the value's actually held up. We're aware of that, but be very wary. We know that private equity has not repriced those assets. And when they do, it's likely going to be a pretty steep negative. We haven't seen all that we need to see. You can't have, this kind of performance in small cap stocks. And, while it's negative, you have these positive performers in private equity. It just doesn't work that way. Because we are seeing different, within that private equity market, we know that there's less IPOs. We know there's a lot of activity that's dried up. So we would expect to see we would expect to see some real challenges with some of those holdings. So if you have some investments that are private equity based, or you're considering making them, don't rely on recent performance to indicate whether or not it's a good investment. I put this chart in here just to show that year to date, not all bond performance was equally bad. Municipal bonds performed less bad of the bad through September. We're aware of it, and international bonds have been a straight disaster. And when you look at how bad bonds have performed, look at where we are going back 35 years. Each one of these gray lines, or the blue lines from last year, is a bond performance. And bond performance has been so negative between last year and this year that it's wiped out more than 5 years of bond gains. It's incredible. This is kind of the worst 2-year stretch of bond performance in recent memory, and it completely fell off trend. I talk about that 40-decade trend. Here's that chart that goes back 40 decades. We can see what the Fed has done and what interest rates have done, broke trend, and we'll have to wait to see where this falls out. Is this going to be a long cycle of continued interest rate increases? It seems unlikely. I'll get to why I think that's the case in another slide or two, but goodness, we're aware that bond performance, largely speaking, has been difficult. But I would also tell you that right now, we're a heck of a lot more excited when we have clients that have had a liquidity event and they have cash to create and establish new bond portfolios, because the valuations are really good and really favorable. So, for those that have liquidity that want to maintain that conservatism and have a decent income, there is an opportunity to start to invest in the bond market now, especially given the couple of years of real difficult performance. Yeah, there's a couple of different ways to look at this. I'll just spend time on this left-hand slide first, where it shows federal debt to public debt. What this shows is that we are kind of total indebtedness, our debt to GDP. We're at this like 120. Well, think of it as like we have anything more than 100% is we have 120% of total debt compared to our GDP. So if our GDP is 30 trillion, if we're sitting at 120%, that means we have $36 trillion of total debt. So are we fed up with that? And what does that mean? This is what it means. And I really want to make sure we get this thing home. So the Fed can't raise rates indefinitely. And part of the reason why is this is an affordability issue, certainly at these interest rates. If you look, when on average, if our treasuries, when they cost us 2, 3, 4%, whatever it might be, this dollar amount in billions, it's in billions. So 1.562 or 1,562 is 1.5 trillion. Look at how much we're spending just to finance our debt. This is where we are at right now. So it's $1.2 trillion per year in interest payments on our existing US government, United States Treasury debt, which, by the way, represents 40% of all tax receipts. So you think that your tax dollars are going to this, that, and the other, 40% of them are going to finance the debt. Soon, and if the interest rates were to continue to go up, look at this. Interest rates continue to go up. It's what? At 6%, it's 58% of your tax dollars are going towards financing our debt. So I think that that's unlikely to happen. For those of you that haven't noticed, the gilt, the 10-year UK Treasury bond had real issues that has been somewhat resolved at this point. We noticed that the Federal Reserve interest rate increases. One of the breakages that did happen was over in the UK. We'll have to wait and see as Fed's increasing interest rates. We'll have to see what else starts to break. That broke, that was fixed. The government stepped in to make that happen, but we'll have to see with all the different leaks in the pipe, in the dam. We'll have to see, what ends up cracking. Same thing in Japan. We're seeing this, our US dollar surging to Japanese currency. Well, that's definitely messing with their system. Still, the United States remains, what is it, the best house in a bad neighborhood in terms of we've got really attractive interest rates compared to most of the rest of the developed world, but with a heck of a lot more quality. Japan is now one of the only countries that continues to be negative with their interest rates. And they need to be, because if you think 120 to 120% debt to GDP is bad, Japan's still sitting at a 240% debt to GDP, which is twice as bad. That's why their interest rates need to stay where they're at. We've seen some improvement in gas prices, so I'll talk a little bit about real assets for just a moment or two. The Biden administration elected to put our strategic reserves to work, and as that happened, you saw this happen, and the Biden approval rating went up with it, and gas prices, again, strategic petroleum release, gas prices go down right in lockstep. And that is in this chart here, as measured, really with this blue line going down and then the yellow following suit. We can't release our strategic reserves forever. I don't think I put the chart in there that shows that we're dangerously low on reserves. As it is, what we're not doing is adding a lot of rigs. And if you look on the chart here in blue, on the left side and the right side, the number of rigs for natural gas and for oil were increasing, but with the price of oil coming down, we're not putting a lot of rigs, we're not increasing the supply, which is creating a lack of supply, which is going to keep prices artificially high. So while we're dealing with oil prices, I mean, I'm not going to get into crack spreads. I wish I had time. What I'll say is that natural gas prices came down. They're moving slightly higher. They're leveling off. We'll have to see. But again, we know that consumer satisfaction is directly tied to gas prices, and we're seeing some improvement there. If I saw bond prices get into this rate here, we might be buying a whole bunch of high yield bonds, but we're watching that data. We don't see it yet. Like I mentioned, gold and silver look good. We're seeing some good discounting finally in closed-end funds, so you might start to see some of those positions come through. Again, we'll see this yield curve inversion. I've talked about that. The last time we had yield curve inversion, it shows, historically speaking, when you have yield curve inversion, that average performance 1 and 2 years moving forward from whence yield curves were inverted, you get good performance in a lot of different areas of growth. That's something that we'll watch and we'll pay attention to. Last couple of slides. I don't want to rush through them, but first is this. In here, this yellow dot. This yellow dot is indicative of both stocks and bonds. And you've got bonds on the bottom axis, which is the x-axis, the y-axis. You've got stocks. You really love to be here, which is both stocks and bonds in this top left quadrant making money. That's okay if you're, excuse me. In the top right quadrant, stocks and bonds making money. This is a great place to be. Wonderful. In some cases, your stocks are making money, but your bonds aren't. But what you have here is you can see just how dramatic this market climate has been, with both stocks and bonds being this negative. You can't find a market that's similar going back decades when you got this kind of negativity. This makes me very, listen, you know me, I'm excited about the market anyway, but this makes me even more excited about opportunities that we're going to be having for investments going forward. And finally, this chart here. I've been putting this chart last or close to last in our market outlooks for the past number of cycles. And what you'll notice is that large cap stocks, the forward expected 10-year returns for large cap stocks is 4.5%. And before you say that's terrible, I understand, but let's remember a couple of quarters ago, the 10-year forward forecast was for 1.5. So we've seen some improvement. So as the market continues to find its footing, and if it continues to go lower, the expected rate of return for some of these things will go higher. You'd likely start to see us making adjustments to portfolios to accommodate like the same kind of thing, like with private real estate. Some of you have noticed where our focus has been there. And if you have additional liquidity, there are some things that we're looking at in private real estate, but private real estate expected for forward return at 7.5 is one of the better areas to invest in. So I don't know. All told, the negativity should make you more positive. All told, that there are more opportunities that we're seeing on the investment side. Gosh, I guess now more than we have in a long time, certainly since April of 2020. So you can look to us to be on top of it, sharpened, making sure that we understand where the market's going. We have portfolios that reflect it. And you'll see for many of you, our concentrated growth portfolio that's coming, real estate portfolio positions as we're starting to add as our economic and market climate continues to find its footing. I think I got to all the questions. I kind of keep looking at my notes. It looks like I did. But if I didn't, send me an email. If you're looking for the slides, send me an email. I'll get to it. Somehow I got through all the slides in like exactly an hour. It's pretty good. I really appreciate your time. Thank you. Have a wonderful day. Let us know how we can help. Take care. Bye-bye.